And just reading here, the Moody's economy.com confidence index, and it is light to be certain, particularly in North America. Let's bring in Mark Zandi, Moody's economy.com. There's a book, updated edition, Financial Shock. Mark Zandi on global panic. Mark, good noon to you.
Good to be with you, Tom.
Are we transitory? You see a confidence drop at your proprietary study. Is it a transitory lack of confidence, or is it something more durable?
Well, I think the economy's slowdown is transitory, that it's related to this higher energy food prices, the Japanese quake effects, a couple of other things that will fade. But I am watching those confidence numbers very carefully because businesses are extraordinarily nervous, as you can imagine, and if they start pulling back in response to these transitory effects, it all could become very self-reinforcing, and the economy won't get going unless businesses pick it up and start investing and hiring more aggressively. So those sentiment numbers, that confidence survey that we conduct every week, I watch very, very carefully. And last week's decline bears close watching. Your
essay on housing I just thought was outstanding. Let's bring up this chart here. Zandi searches for the mean, and we're going to do a much longer treatment on this chart tomorrow. You will see this. This is an obscure Census Bureau chart on the constant quality index. You usually don't see that, but there's a slow rise in housing and then the big surge in housing and how we've leveled out. Mark, are we back to the mean? Are we back to the mean trend of housing?
Yeah, I think house prices are back close to what you might call the mean, the equilibrium value, fair value, that if you look at house prices relative to incomes, household incomes, housing is very affordable. In fact, it's about as affordable as it's ever been in the data that we have. If you look at house prices relative to renting, effective rents, house prices are still a bit high, but they're coming down, and of course rents are now rising. So I think we're pretty close to fair value with respect to house prices rent. So you take it all together, right. I think house prices are close to equilibrium, close to fair value.
Headline coming across the Bloomberg in the IMF Derby, Secretary Geithner coming out and he says, quote, such a strong field, is how he puts it, looking at Lagarde. Karstens of Mexico and Stanley Fischer suggested as well. Mark Zandi, let's go off script here. Do you have a certain predilection towards who you'd like to see run the IMF?
No, I think all those folks you mentioned are good candidates, and I think that highlights a very important point, and that is the bench at the IMF is quite deep, and I think that it's digesting its recent problems quite well, and there's been no disruption to global policymaking or the functions of the IMF. So I think whoever they decide to put at the top of the IMF will do a great job. Those names are all very good. And more importantly, the folks at the IMF that are always there, they're competent in doing an excellent job for us.
Let's get back on housing, Mark. Here's new homes. We all know this chart. It's off a cliff. New homes from 1 million down to 300,000. Can policy changes with your lengthy study, particularly the bifurcation between distressed homes and non-distressed homes, can policy matter here, Mark?
I think there are a few things that policymakers could do. I'll mention one, and we can explore others if you'd like, but the one that I think would be easy to do, helpful in the very near term, is to extend the conforming loan limits. As you know, Tom, those limits are the limits on FHA, Fannie and Freddie. They can't go above those. They can't make mortgages that are bigger than those limits. Under current law, those limits are going to decline. So many parts of the country where you have a lot of high-priced homes and bigger mortgages, like where you live in New York, on the Northeast Corridor, in California, parts of Florida, it's going to get tougher to get a mortgage loan, and the mortgage loans you do get will have a higher interest rate. So I think lowering the conforming loan limits is a good idea. It's a good way to try to get the government out of lending, let the private markets come back. But I'm not sure I'd do that in October. I'd probably extend it for a year. But of course, that'll take an act of Congress to do. And that would, at this point, that seems unlikely.
Almost a philosophical question, Mark. Are we trying to go back to the housing market that got us into this mess? Do you see us staggering into 2012 in some kind of new more private-dominated housing market, or are we just trying to repeat history here to get the price stabilized?
I don't think we're going back to and I don't think anybody wants to go back to the housing market, mortgage finance system that we had in place in the bubble. I think, everyone agrees that that was a huge error and was the main contributing factor to the financial crisis and panic that ensued. And I don't think there will be any major changes to the mortgage finance system for a number of years. That it won't even be legislated on until after the next presidential election, and then it'll take a couple of years after that to get started, and it probably won't be until 10, 15 years down the road until we make any significant measurable changes to the mortgage finance system.
One more
this
chart
is not something that's going to happen near term.
Right, Mark. One more chart on housing. This is just house vacancies. Mark had some wonderful, very sophisticated charts on distressed properties. How much of those house vacancies are distressed?
I make a distinction between the distressed properties, the foreclosure and short sales. Actually, I asked a good question. Let me put it this way. Of the 1.5 million vacant homes that are out there in excess of what a well-functioning housing market would have in vacancy, roughly half of those are vacant homes, and so therefore they are under any definition distressed.
Mark, there it is. It's a shock to see it on the screen, even with all of our preparation. A triple C for Greece. There's the headline, folks. Look, the headline matches my pink shirt and bow tie. Perfect. Mark, this is serious stuff. We've now come to a triple C rating. Based on your reading of the weekend events, which institution should we watch in Europe now for a resolution to this challenge?
Well, all of the above. They've got to come to an agreement, the ECB, the EU, the Greek government. I think at the end of the day, when this is all said and done, the Greeks will not default or restructure, certainly not this year, probably not next year. Ultimately, down the road, it's going to be tough for them to get through this without some kind of restructuring. The odds are high that they'll need to do that. But I would be very surprised if European policymakers allow that restructuring to happen anytime in the near future. That would be taking a big chance with the entire European financial system, the banking system, and the global economy. And I just don't think they'll go down that path. A
la AIG, is the real distinction here they have to deal with those credit default swaps and the follow-on to the triggering of those credit default swaps if we saw some form of default?
Well, I think that's certainly an issue, and it may be that because they don't really have a good grip on the exposures there, that just adds to the level of angst, and one more reason not to go down that path. Experience something like what happened after Lehman when policymakers clearly didn't really understand all the ramifications of allowing Lehman to fail. The same kind of process here. So, that may be one aspect of it. But more importantly than that, if you look at the European banks and their exposure to Greek sovereign debt and the debt issued by Greek banks, it is quite significant. And so if the Greek sovereigns default, of course, the Greek banks would default, and it would put tremendous pressure on the entire European banking system. And I just don't think they'd want to take that chance.
Looking here, folks, at the 10-year is a 0.40 now into 0.39. The 2-year and the 10-year comes in right now. The handle's at 2.95, 2.96%. So yields in a little bit. Mark, I want to bring up a consumption chart. This is a new chart, long-term view, and it's consumption to GDP. Mark, boy, has everybody been wrong on this. The idea that consumption would get back to 65 or 66% of our GDP, there it is, elevated as a percent of GDP. That chart back to near World War II. We consume, we consume, we consume. Where are we right now in this? Do we really need to do less consumption, or is that just economists worrying?
Well, no, we need to continue to consume. We need consumers to at least do their part. But even more than that, we need global consumers, the rest of the world, to consume more of what we produce. They are. Export growth is now strong, has accelerated since the recession, and I expect that to continue. And I do expect that that chart that you're showing will change, that the share of GDP that's accounted for by U.S. consumers will start to come down. And when we're chatting 10 years from now, Tom, and you're putting up that chart, it'll be the consumption share of GDP probably will be closer to 65% than 70%.
Very valuable. Thank you, Mark Zandi, not only on the U.S. economy, but of course on Greece. S&P goes to CCC on Greece. I believe Moody's now, I believe it's 7 levels below investment grade. Absolutely remarkable.